Secrets to Abundant Living podcast community. Welcome. Welcome to part 2 of Volatility Insurance, how to shield your wealth from economic and monetary storms in 2026. As I mentioned in last week's episode, our investor club has lots of educational webinars and material, and typically that information is exclusively to our investor club. But this was just so important and so essential. I figured I'd release it here on the podcast so that everyone can benefit. We are living in interesting times without a doubt, and this information is for education purposes only. But of course, something we are interested in sharing in terms of what we are personally doing, not financial advice, not investment advice, but just information to share with you all to digest, do your own research, talk to your financial advisors, and all of those great things. So if you haven't watched part 1, make sure to go back and not miss that. Very, very important points. And our guest, as a reminder, is Bruce Fraser, managing partner of Elkhorn Capital Partners, my personal business partner on 5 apartment complexes throughout the United States, and just a brilliant macroeconomic and investment mind whom I respect tremendously. And I couldn't hold this information back from you all. So please enjoy part 2 here, and we'll see you on the flip side.
Welcome to the Secrets to Abundant Living podcast. Your guide on this journey is Amy Sylvis, ready to unlock the keys to a life of true abundance. We're diving into everything from financial freedom and optimal health to meaningful relationships, geographic freedom, and everything in between. It's about creating a life rich in experiences, purpose, and joy. Get ready for empowering conversations, expert insights, and real-life stories that inspire you to live abundantly. If you're ready for the secrets to an abundant life, hit that subscribe button now, and let's get started.
So is Warsh coming to save us, Bruce? Is that is he our savior?
I've read a lot about him, and he is a very smart guy as well. And so that gives me optimism. He, certainly more qualified than Janet Yellen was. That
all
was just
5'2" of her. That's what I like the best about her.
Yeah, some of the things she said were just terrifying. But interestingly, for those on, I don't know if they're familiar with this because they're not investing well, but there's a guy named Stanley Druckenmiller, and he is probably one of the best investors ever. He has averaged over 30% per year on his own accounts. He used to run a hedge fund with George Soros, but now only runs his own money, and he's a billionaire, obviously. But it doesn't take long to compound nicely when you're making that kind of money. Yeah. But both Kevin Warsh and Besant both worked for Druckenmiller at one point in time. And so, they are very, very smart people, or they wouldn't have had those roles. Kevin Warsh was actually involved when, you may have heard the stories, when Soros almost bankrupted the UK by trading the currency against it. He was heavily involved in that. So he knows what can happen with currencies very deeply. But when they announced that he was probably the pick, the markets plummeted, if you remember, because they thought, oh gosh, this guy's a hawk. Hawk means that he's reticent to raise or to lower interest rates. Right. And Druckenmiller actually came out publicly and said, the market is misreading him. He's not a constant hawk. It depends on the scenario. Right. So what Warsh wants, he does want to cut interest rates to help fuel this growth that they're looking for. And he wants a deregulated environment and things like that, because they need growth at all costs. Yeah. But he also wants to reduce the Fed balance sheet. Now, I don't know how you do that when there's nobody to buy your debt, but good for him. It's great.
We love that for you.
I'm glad. I'm glad I don't have either one of those jobs. Yeah, I know that because it's really complicated. But he's what they call a supply sider, which means, they're promoting pro-growth fiscal policies, simpler tax codes, deregulation, things like that, and against protectionism and those sorts of things. And so, I think that they've talked about, basically they called it an accord between the Fed and the Treasury, which means he sees an environment, as does Besant, where they are working hand in hand to accomplish the goals that they want. And they both see a world where there is a monetary reset. So, I think the market's got it wrong. I do think he's going to cut the federal funds rate. Now, does that mean that the treasuries rate will go down? No, it doesn't. We saw that happen this year or this last year when the Fed started cutting, treasury rates actually went up. Well, that's not something that they thought would happen because they thought they were all powerful and they could control rates. Well, in a market that size, they don't. The debt holders control what interest rate there is. Now, they can't affect it because if people say, you know what, you're cutting interest rates in a time when there's inflation, that creates weakness for the dollar. We're very concerned that you're not going to be able to repay the debt. So people start selling the debt and that forces the price down, which forces the yields up. But what I think is going to have to happen is the Fed or the Fed and Treasury together, Best will have to step in and buy the longer dated treasuries to help bid up the price and keep the interest rate lower. And so, but how they do that while shrinking their balance sheet, I have no idea.
Those definitely seem to contradict themselves. And one wonders if the Fed, I think Warsh has talked a little bit about creating maybe a little less transparency and doing a little bit more kind of signaling, if you will, than Powell did. Powell seems to be very straightforward. We say we're going to do this. This actually comes to fruition. So I don't know if I read that
He
right.
wants to do away. Yeah, you did. He wants to do away with the dot plot, which a lot of Wall Street focuses on now.
Right.
It's kind of funny because the dot plot is one of the least accurate indicators of interest rates ever, but people focus on it and because it's an expression of where the Fed is saying they think things are going.
Right.
He wants to eliminate that and does want to do fewer interactions with the press and things like that. They just want to take action as opposed to postulating and trying to talk the market different directions. We saw a situation where the yields or interest rates have really been constant, in the last part of the year at least, but we still have divergence between that and the dollar. The dollar is selling off in spite of rates not being cut. And so normally interest rates are supportive of the currency. And so, if you raise rates, it would usually mean your currency would increase in value. But, we're seeing a break from that. And that's just telling us that people are kind of losing faith in the dollar. This is not an overnight kind of thing. I mean, people are still going to use it for transactions, for a very long time. It's just a matter, but it's not a store of value. And that's what people are kind of waking up to. There is counterparty risk. They're all aligned to say that they want a monetary reset. So, those are all potential negatives for the dollar. So we'll see. He's also of the mindset that AI is going to be very impactful from a growth perspective. That's a really complicated subject, but you've probably seen the process of Anthropic, and so the rate at which it's learning and the rate at which it's increasing its capabilities is just step functioning, honestly, week by week almost. And, I look at how we've used it and, earlier last year, we were using it. Hey, we hired a new analyst, I think, and
Yes.
rebuilt some of our financial models and asked the AI, hey, how do I create a formula that does this? And then we give it to it. Now, just not even a year later, you just describe for it what you want the model to do. And it builds it for you, the whole thing, not just a formula. So, it's really rapid. How that plays out, they're going to be dramatic labor impacts, I think. And, how and where that hits, I don't think we fully know yet. But I mean, it just last week, I think, created a couple movies even. And I haven't seen them, but I've been told they're pretty good. And so now people are thinking, gosh, LA, it could be a nasty for LA, right? And you might get some, I don't know, but we'll see how it plays out. It's early, but on these kinds of things, you have to position for where you think it might go. Otherwise, it's kind of too late. So.
Well, and that leads us to the brilliant line that you use with many of your LinkedIn posts, which is position accordingly.
Position accordingly.
Yes. And we could listen to Elon Musk, who tells us universal high income is going to be all of our savior, Bruce, but that'd be nice. But I question kind of the economics of if everyone has a bunch of money, no one has a bunch of money. But anyway, I don't think we're going to do that. We're going to try to protect it.
And the government won't have a lot of money because they'll lose a lot of taxpayer base, right? And so the money for UBI would have to be printed, which is inflationary. That's the thing. If my kid, if our kids both get, an allowance a month, let's say, and you give them that, but then you double it, well, you know what? They're going to be able to pay more for stuff, and they, push the prices up because if there are only 3 apples in the world and you've got 5 kids, well, somebody's going to pay more for it, right? And so that's just kind of how it works. But it is very complicated, the AI impact, but I don't think we even know where all it's going to impact. But I do feel good about our investment thesis still. We talk about it daily, but we really focus on distressed situation turnarounds. So create substantial equity pretty quickly, but also our tenant base it's workforce. And so they're really laborers, people that are doing things with their hands. And, people that make their income from interacting on a screen, we don't know, could impact them certainly with AI. And so, but people that are laborers, yeah, 10, 20 years from now, it could be robots, sure. But I mean, I think shorter term, you know, I mean, they're not going to be replacing maintenance guys with robots anytime soon in our apartment complexes, or serving tables, waiters and waitresses and things like that with robots anytime soon. It could happen, but there's a cost barrier. Sure. A restaurant can't afford to go buy a $250,000 robot to do something. So
Right.
I feel like relatively insulated, but the world could get crazy. I don't think I would want to be in A-class stuff right now because there are going to be so many white collar, we don't know which industry it'll necessarily come from, but there's certainly risk in finance and other areas. And, the people that are in the first 5 years of their career, let's say, that are working a brain job, those are people that usually go into those properties, and so I don't know how that's going to impact things.
I love that you bring that up. And for anyone that's watching that doesn't quite know the different classes of apartment complexes, Class A is generally some of the newer, and by input and by design, it tends to be the higher rent, maybe more white collar in general type apartment complexes. Class B is a bit more in the middle. Class C is that older vintage 1970s. Are we going up to 80s now for Class C, Bruce? I think there's yeah, maybe.
I actually go either way.
Yes.
Depends on where it is, probably.
Yeah. But this classic workforce housing that Bruce and Elkhorn Capital focus on, that does cater to the more blue collar folks that may be less impacted by things like this. I'd love to hear a bit more kind of about your thesis there, Bruce, if you don't mind wrapping up with that and kind of how that relates to the microeconomics that we discussed here.
Of C specifically, C-class workforce? Or
Just how you're thinking through protecting and preserving your wealth. I mean, you've had great success, obviously, in investing in various asset classes. So why multifamily? Why the C-class workforce housing specifically? How are you thinking through that?
Yeah, well, I was invested in real estate, as you know, prior to '08 on investment properties, and my partner and I sold everything in '07 that we had because of the recent retreat of our hedge fund. So we were very concerned about what was forthcoming. Fast forward, we formed Elkhorn in 2010 because looking at the financial crisis and what was going on, again, it's just math, but we knew the Fed was going to have to print a bunch of money, which would create inflation. So we wanted to trade our fiat currency paper dollars for something real. And so a lot of people call that hard assets. So what hard assets did we want? There are plenty of good options, timber property or oil and gas mineral rights, or certainly multifamily or retail or office. I didn't like retail or office because it's too business cyclical. And so, if there was a recession, if there ever would that happen again, I didn't want to be exposed to movements that I couldn't control. And so I really honed in on multifamily. I like it a lot better than single family rentals. Some people do SFR portfolios, but it is so hard to manage and so hard to influence the value. The difference between single and multi, if I was able to buy a single family home for $100,000, but I was able to collect somehow 15,000 a month, which is not possible, but let's say that could happen. It doesn't matter because at the end of the day, when I sell the property, it's going to trade based on single family comps in the area. And so it's going to trade as a $100,000 house. And so if I buy a multifamily property, it's like buying and selling a business, but you're trading on a P&L. And so I can improve that P&L by either increasing revenue or decreasing expense. If I drop 100 extra grand in the bottom line, I probably created $1.5 million or more in value, depending on the cap rates in the market I'm in. And so you can force this value creation by being smart about how you invest your money and what amenities and what things that you do to the property. And so I liked the residential component of it because people always have to have a place to live. I liked C because it has historically been the most economically, it's been least sensitive to economic cycles.
Mhm.
Because if you're in the nicest A property, let's say in uptown Dallas, for example, there's some beautiful properties there, but you know what? If times get hard or people are making less money, they don't have to have a wool stove. GE works just fine. And so they'll trade down. And you see it's not bottom rung. You got government housing and, maybe some D assets below it, but
Oh, yeah.
it's where a lot of people work and they need a clean, safe place to live, but they can't afford, an A property. And so I liked that nature of it. People trade down during hard times. So guess what? We're C, and so they might move out of a B and say, I don't need to have a property that nice. I just need a safe place to live. So that's kind of how we got there and why. That's not to say some of the other options aren't good. Really what you need is to have a good or service that you can trade for whatever the going concern is in the future, whether that's a lot more dollars because of inflation, whether it's grams of gold, whether it's yuan, whatever we're trading in 10 years from now, or, if I have oil and gas mineral rights and, get sucked out of the ground 10 years from now, I am protected from inflation because I can trade it for, whatever the transaction currency is at the time. And the same thing goes to multifamily. On a property, we have units, if inflation goes up, then we'll raise rents. Now a lot of people got this wrong. There are a lot of markets. I won't name markets because I don't know everywhere you own, Amy, but I think you're smart. And so you probably got it right. But there are markets where just doing the work on the quantitative side and looking at supply data, looking at population growth. I know you're very public about, hey, I live in California, but I don't invest in California.
Yes.
And, that's so well said. Yeah, I wouldn't touch buying a property in California because if I have a product and I can't force the people to pay me for it, that's a pretty terrible business. And the landlord laws on the coasts, not just California, but East Coast as well as some other places like Seattle and others, the rules are just so anti-landlord. I can't imagine why you would want to put money and capital to work in those markets because you can't evict a tenant if they don't pay you. Once they learn you can't evict them, guess what? They don't pay you, even if they have the money. And so it's nuts. And so we are very focused on kind of the South and Midwest. One of the things we look at are just business-friendly environments. And we also look where the population's going. Oklahoma is not sexy, but you know what? It's a top 10 market for a recipient of population growth. People are moving to that market. And, Dallas is certainly higher on the list, but it's also an environment with so much capital chasing deals here. There's so much supply being built. Dallas is one of the ones that I would knock on for supply. There's some very large markets in the country where I have friends that bought in all of them. And it was clear that they're building when all those new buildings come online, there's going to be pressure on rents because you want a brand new one instead of a 5 or 10 or 20-year-old one. But the other thing that a lot of people missed, and this is specific to another town in Texas, but the rents were so far above the median income or the national average that it just wasn't affordable. Austin was just recently listed as the market with the most rent reduction in the last year. And that's exactly why. It's a combination of supply coming online because it's sexy to build there. It's easy to raise money to go build a development in Austin because everybody likes going there.
Right.
But my daughter lived there for a while, and I know firsthand. She's like, Dad, if they move me to the market rents they're posting, I'm gonna have to move. I can't afford it. And so it's literally not a decision. They're well over the national average of 30%. These deals that you just participated in with us recently, after we buy them, fix them, and raise rents, we're at 22 to 26% of the national of the median income in the 2-mile radius of those properties. Well, that's super affordable. And so even after we raise rents, people can afford to pay us. And so we look at things like that very closely. We look at unemployment rates, job trends. The supply of C properties in Tulsa is actually going down because some of them have aged out and they've been torn down.
Yep.
But there are a lot of manufacturing jobs coming in. That town is doing a lot of good things to attract companies there. Your land's cheap, other good reasons. There's actually one of the furthest inland ports is out just outside Tulsa, which blew by my life. Fish like a port. What are you talking about? But it is. And so that creates a lot of opportunity as well. So a lot of good things happening, but we really dig into markets. We don't just pick a market because we got an OM from somebody, from a broker, or we had a friend buy there. We want to know why we're there. And so I think a lot of people kind of didn't know why they were in the trade, so to speak. But, I had some friends when I was at an offsite with a handful of operators and peers. You mentioned LinkedIn, and I don't post often, but when I do, it's thoughtful about macro and kind of what I see going on. But they followed me and they were saying, gosh, I thought you said this was a great inflation hedge. I said, it is. So when I'm getting hammered, I said, well, you did it wrong. You bought in a market where you don't have pricing power and you floated on your debt and your expenses. What we're trying to do, we're trying to lock in not just our fixed rate debt, which we had even before the rate hikes, because we knew over the trade. We know rates should be higher than they are because of inflation. And so we were fixed on everything. But we also are looking at vendor contracts, and we get 3 years on this instead of 1, and fixing our costs and being on the right side of that. And so, and then we were in markets where, like I said, they're super affordable, where the tenant or the population can afford the rent increases. So that's kind of why we're doing what we do.
Have you ever thought about having multiple streams of income? Instead of relying on just one stream of income where you're trading your time for money, how would you like to free up more of your time and live a more abundant life? As a listener of the show, you're invited to attend one of our upcoming trainings where I'll give you an inside look into how you can add passive income and get all the other perks of recession-resistant real estate investing without the headaches of being a landlord. I'll also be sharing some hidden mistakes to avoid and the criteria I personally look for when evaluating potential investment opportunities. To reserve your seat for free, go to sylviscapital.com/webinar. Again, that special link to reserve your seat for free is sylviscapital.com/webinar. I look forward to seeing you on the training. And now back to the show. Powerful. I love that you mentioned all of the downsides that you are avoiding and not just the reasons for what you do. So I think that's incredibly important.
And it's not always about saving money. Like, I look at our payroll, and our average payroll is probably higher than some other operators, but we pay market base, but we have incentive comps that if they're hitting their goals, we're making millions of dollars, and they make more than they could make anywhere else. But what a lot of property management companies do is they just squeeze those employees, and you end up with a very dissatisfied employee that could walk out any hour of the day because it's a tough job and go wait tables and make more. And so it's replaceable. And I think that the jobs with us are not replaceable for those people because they're probably making 50% more or even 100% more than they could make anywhere else.
Right.
So they're very motivated. And if our payroll is high, we're thrilled because that means they hit their goals. And we've done very well for partners ourselves. So you have to be sometimes non-traditional about your thinking and focus on just the results that you're looking for, not necessarily fixating on cutting costs or something. And another thing we've done, we have a team of 5 people that are just float amongst our properties. That's a burden of cost that we took on, but it saved us a ton of money because now we don't have to third party or turnover and make readies or minor construction. The team just, applies the hours that they work on a property that week and they get paid by the different properties. But, that, for example, washer dryer connection, cut our costs in half, and it went from 1,300 to 650. And, that's a lot of money. And so you throw a cap rate on it.
Yes. That multiplies.
But there are other things I'm doing too. You see the screens behind me. I'm still very, very active in the public markets, oversee close to $1 billion in the public markets, a quantitative strategies, not emotional. But, my personal account, I'm positioned accordingly for my views of what I'm doing. And, you don't have to have tons of capital or be, worried about exposing it to some of these ideas. You can use options, and options scare people, but you could put a lot less capital at risk if you use options for a bet and get, the same payoff of this thing if you had a large position. And so I use a lot of options, and you don't have to know everything about them, but there's a place called the Option Industry Council, OIC. It's a great resource. It's just an investor resource, has lots of videos to teach you how to do different strategies, or even you can go there and say, this is, I'm bullish on this. I think this is going to go up. What strategy should I use? And it'll tell you, and has a video on how to do it and all of that. So that would be something I don't think we've talked about before, but something that would be good for investors to try to kind of get an extra bang for their buck. Without going crazy. And, really what you probably would want was long call options or buying calls on something that you think could move. We're talking about gold, maybe it's on gold, maybe it's on gold miners or something commodity related. Something like that.
I think this means I'm going to wrangle you into doing another webinar about another topic, Bruce. You are voluntold. Congratulations. No, I'm kidding. No, this is really helpful.
I was going to say, I've been talking to it about, I'm very open and transparent about what I'm doing with my own account and with the team and stuff. It's so funny because you know Matt well, but I would say things and then I would get busy on the call with a broker or something, and he would actually put the trade on and I would forget, because I got busy, and that was a great idea. I'm like, oh, damn it. Well, this time, it was so clear to me. It was so, and what we've been talking about was happening. Then I did position for it. And, thankfully I was on a podcast with someone, probably maybe a year and a half, 2 years ago. And they asked me, what was one of the things that I regretted about my career? They're like, you've been obviously very successful, but what's something you regret? And there's some things I probably shouldn't say publicly because of different personnel or something like that. But I thought about it. And, I said, it's probably when I had incredibly high conviction, like in 08 or 07, I didn't position heavily enough for it. I'm not talking about taking an outsized position, but using calls or something like that, where, if I'm right, this is going to be meaningful.
Right.
I made money, right, personally in my account, but not as much as I should have. I mean, I didn't know, but the math told me the S&P was going to go below 700. And, we went to 666. And, if I had told it, in fact, I had another advisor that he had a bet with me. He's like, there's no way. I'm like, that's just the math. It's just, if you take what the bottom PE normally is in a downtrend and what the earnings are going to be, it's going to be sub 700. And so, I stayed out of the way, made a little bit, but I should bet better, bigger on it. And so this time around, when this is one of the highest conviction things that I had, I was like, you know what? I have more money now, but I also had higher conviction. I was like, you know what? I'm gonna put a decent sized thing on, and I did, and it's been crazy.
That's great. That's great. We've got a
Because
couple.
one of the other ways,
Go ahead.
let's say just one quick thing.
Yeah.
One of the other ways that you can beat inflation is just to make a higher return than the inflation rate. It doesn't have to be hard assets, but if you can make a rate that's higher than the inflation rate, which is hard for people to do, especially if it's upper single digit inflation, but that is another way to protect yourself.
I like that because the conventional wisdom is really hard assets only, right? So I like that nuance that you talk to of, that's really the threshold. If you're making a higher return than inflation, regardless of the asset class, you're ahead of the game.
Yeah, you have to adjust for taxes too, but yeah.
Well, there's that too. Always taxes.
Especially in California.
Don't remind me. Folks, if you've got questions, says Bruce in Texas. Bruce is beating me there. Folks, if you've got questions, we've got Bruce here for just a couple more minutes. Obviously, you can see the depth and breadth of his knowledge, both in macroeconomics, but of course, in investing specifically in several asset classes. Looks like Sam, thanks for your question, Sam. He'd love for you to speak about potential macroeconomic impacts of population reduction on rents and multifamily investing.
Of population reduction? Hopefully he doesn't know about a nuke that's going to go off or something. But it's interesting because that's a longer term trend. I think that the birth rates have declined over the years for sure.
Yeah.
And there were articles out the last couple of weeks just about Gen Z. I think it is just well, I don't know how to say it real cleanly, but they just are not having sex as much as older generations did.
Yeah.
And so, that would obviously result in a lower rate of birth rate and increasing the lower birth rate. So that is something that's kind of a multi-decade thing out there. But I think that trend would have to be more rapid to be offset or to more than offset the inflation impact. And so I think the inflation impact is stronger, but it is a fair point. Certainly we're seeing that, and even without, you can see population reduction impact from population migration as well. And so we're seeing people move out of California, moving out of some other markets in Texas and Florida, things like that. And so those markets certainly have been impacted by that. I get emails from brokers trying to sell stuff in San Francisco. I'm like, I've never once expressed interest in buying in California. So I know they're really trying to throw their net widely because of that. It's that impact that you bring up.
Just to stack on that, because that's a really good point. Sam, the other thing too that I love to remind investors is there is no one United States real estate market. So although there may be trends on a countrywide basis, and it's very much worth paying attention to, there still may be areas like Tulsa or Oklahoma City that are growing tremendously. So that's why we are so hyper-focused on market research.
Yeah. Yeah, it's really, really important. And I had a lender that had not loaned in Tulsa before, that when we bought one of our assets, they asked, he came down, he wanted to check all the stuff, all of our assumptions, and really check the rents, because we found a property at the time that their rents were more than 20% below our C assets in C- neighborhoods. And this was a B asset in an A neighborhood. And their rents were lower than ours for the same size out. And he's like, that's not possible. And so we showed him our assets, showed us stuff in the area. And it was, a 30-year plus owner, and they were just kind of asleep at the wheel. But, we had breakfast one morning and he said, why do you like Tulsa? And I start listing all the quantitative reasons, like, these are all the reasons. And I said, I would never invest in this market for the same reasons. And he kind of smiled. I said, what? He said, we have deals that are going badly in all of those markets. And I think you just named. It's like, yeah, that's just because people aren't doing the work. There are always good markets. I think it just depends, like Sam said, where's the population going, where are the jobs being created? And that's going to put weight in your sales.
Yeah. Really astute question, Sam. Thank you. Anyone else here? Well, while we're waiting, we're going to put Bruce's information in the chat, elkhornpartners.com. Hopefully I got that website right. I'm pretty sure I did, right, Bruce? And we also,
That's right.
yeah. And then we also put your LinkedIn earlier. You all will get a recording of this webinar as well with all the contact information. I'm with investwithamy.com. We really appreciate you all joining us here today. There is so much going on. I have a feeling I'll be able to wrangle Bruce in for maybe a mid-year macroeconomic review as, you know, the Fed chair is confirmed and we maybe see some movement in some ways come May or June, but we'll see.
It's going to be interesting. We know that.
It is.
We'll be thinking about it and trying to game it correctly. But yeah, I would encourage you said to share the link, but I would encourage you, the people watching this, to do connect with me on LinkedIn. Like I said, I'm not spamming people with, hey, this is what I had for breakfast, or this is, picture of me wherever. It's always, it's probably one every couple months or something, but it's usually something that's a major topic on my mind. And I'm trying to really call it down to simplify it for people, to translate it to how what that could mean investing. And so I've gotten a lot of great feedback on the posts, and
Yes.
so I'd encourage you to reach out.
Yes, yes. Todd would like to know, where can I find more trusted information on monetary reset?
Yeah, so I would Google Moran. He's one of the guys that a Fed added to the Treasury Board.
Mhm.
He wrote something called the Mar-a-Lago Accord,
Okay.
and it's available online. I don't have a link. I can try to find it, Amy, and send it to you. But it's exactly the game plan of what he's thinking. And
Okay.
he was the first person. He's the first person that Trump put on the Fed board. So that kind of tells me their thinking is aligned. Trump doesn't usually respond well to people he's thinking is not aligned with. So
Right.
I think it's fair to assume
Yeah.
he's bought in on that idea.
Yeah. 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 Perfect. If you're able to, we can pass that on to you, Todd. That's a really good question. Thank you.
It is.
Well, Bruce, thank you again. So grateful. I know you are a busy man in more ways than one, and taking the time to share your knowledge and help us plan accordingly is so valuable. So thank you again for joining.
Happy to do so. And that's why I do it. I don't want to be the one guy at the table that has a stack of coins in front of me and everybody else is struggling when they're like, why didn't you tell me this was going to happen? That's what I'm doing. I'm trying to tell you what's happening, or what I believe is going to happen. So you can position for it.
Appreciate that abundance mindset.
Glad to be here. Thanks, Amy.
Thanks, everyone. We will see you again soon. Have a great day. Thanks again, Bruce. Bye for now, everyone. All right. Well, thank you again for joining us for part 2 of this educational webinar with the great and powerful Bruce Fraser of Elkhorn Capital Partners. Really, really grateful again to have him on the podcast. Make sure that you find him on LinkedIn. Follow him. LinkedIn is such a great place to keep updated, particularly on this educational content. Again, not for investment advice, but definitely great education for you all to keep in your back pocket as you make decisions that are best for you and your family's portfolio here moving forward. And we appreciate you joining us here on the Secrets to Abundant Living podcast. We look forward to seeing you on the next episode. Have an incredible day. Bye for now.
Thank you for joining us on another episode of the Secrets to Abundant Living podcast. We hope you found inspiration and valuable insights that will empower you on your journey towards abundance. If you enjoyed today's episode, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us, and it helps others discover the secrets to an abundant life too. Stay connected with us on LinkedIn, Amy Sylvis. Keep striving for your goals, nurturing your relationships, and embracing the adventure that is life. Until next time, we wish you an abundantly fulfilling day.